markets for the moment are not going anywhere, but like I always say that good news and good prices, they rarely come together. A lot has happened in the world, a lot will change in the world in 2017. We are pitted against a lot of events, a lot of political events which really could be market moving in nature. But my guest today is someone who has seen many market cycles, who understands the importance of long-term investing and believes in sticking to his principles irrespective of the underlying global news or the background noise. Prashant Jain of HDFC AMC. Prashant, first a very happy new year to you and your team, and thank you for joining us.
No, pleasure, thank you, same to you.
When we started the year 2016, I'm taking the clock back, the assumptions were different. The assumptions were economy will pick up, earnings will pick up, margins will expand, commodity prices will remain low. The assumptions this year are very different. The assumptions are demonetization will have effect on India, world will change because of Trumponomics, and commodity prices will remain volatile. So a lot has changed in last 3-4 months.
Yes, that's right. I mean, so that's why we always say that taking a one-year view on a volatile asset class like equities is probably not the best thing that we can be doing.
Fair point. You've always said that equity should be considered by investors who have a time horizon of at least 5 years. At least 5 years. So we are not going to, navigate away from that template. But let's understand the risk reward ratio in this kind of a market. What drives any market are earnings. And the challenge for this market is that there are no earnings, and earnings recovery will be delayed for 2-3 quarters.
Yeah, I don't have a view on 1 or 2 quarter earnings, but let me give you a picture of how we see earnings playing out. If you look at last 2-3 years, all sectors but 3 sectors in Nifty have delivered reasonable growth in earnings. And the 3 sectors where earnings have not grown are corporate banks, both in public and in private sector, number 1. Number 2, metals, and number 3, engineering and construction companies. And each of these 3 sectors had challenges specific to them. Banks are grappling with high provision costs. Metal prices were quite low till last year. They have recovered of late. And engineering, we know the capex was quite weak. And these are the 3 sectors where earnings have actually fallen by 50% odd. And that is the result of weak aggregate earnings growth. And that is what we have always said, that aggregates hide a lot and you can't really focus too much on the aggregate. But now as we look forward to the next 2 years, what is happening? Interest rates are moving lower. Almost 50-60% of the bank deposits have been lent to the companies.
Yeah.
That's a massive number. Maybe 50 lakh crores or something like that. If you save 2% on that, it is 1 lakh crores a year, which is a very large percentage of the profits of Indian companies, and that will flow through. So I think lower interest costs will itself support significant improvement in earnings. Besides that, these 3 sectors what I mentioned, each of these are likely to see a return to normal profitability over next 2 years. In metals, we are sharply moving in that direction, and we should see it in the next few quarters itself. Corporate banks, I think over next 2 years, most people agree now that the worst of NPAs, the provisioning costs is behind us. They may still remain high than normal, but over next 2 years you should see a return to normal levels of profitability. And engineering and construction, we are seeing very good improvement in roads, in railways, in power T&D. So I believe even in that we are moving in the right direction. If you look at market cap to GDP in India, we are trading near all-time lows of market cap to GDP. But P's are not close to all-time lows. And the reason is because corporate profitability is still near a cyclical bottom. I think over next 2 years we should see improvement in aggregate profitability and earnings will catch up. But I agree with you that we have said this in the past, in last 2 years, that earnings should start growing, and for some reason or the other that earnings have so far not materialized. But I remain quite confident that earnings will catch up in the foreseeable.
So we'll talk about these sectors and themes, but right now let's look at the big topic, which is the impact of demonetization on the economy, on the market. I'm not looking at putting words in your mouth, but do you think somewhere the economic benefits of demonetization is going to be far less than what it was originally perceived, and slowdown which markets were fearing is going to be much more than what markets are betting on?
I think one is we should not link the impact of demonetization to the short term slowdown, because after a quarter it will not be felt at all.
Even in consumers, even with discretionary?
No, I don't think so. It will be felt at all. I mean, you can look at what Maruti is telling you.
Yeah.
Car is the most discretionary item for a middle class person, and you can see how things are reverting back to normalcy very fast. So, I don't think we should read too much into 1 month or 2 months numbers at all, particularly for discretionary items. As far as the longer term benefits of demonetization are concerned, I think they should play out to be very significant. This whole move towards less cash driven economy or more digital payments can bring immense benefits over time. They can lead to ease of doing business, they can reduce the informal economy, they can widen the tax base, they can improve the tax to GDP ratio of the country. Over time it can in turn lead to moderate levels of taxation. So, I think we should wait for the next few years and see this transition from a highly cash intensive economy to a less cash driven economy before we pass a judgment on the success of this initiative.
Now, when a reset like this or when a reboot like this happens in the economy, the entire market leadership and the entire way how earnings would move would also change. So, what do you think would be the big beneficiary of demonetization, and where do you think the loose nuts are going to open up further?
I mean, in our opinion, I mean, the short term impact varies across sectors, but if you look at 1 or 2 years out, I think most sectors stand to actually some benefit and some are neutral. And the only sector I think which will have to change the way it does business is non-banking financial companies, because POS transactions and POS machines are going to become a way of life. And once POS is established, even both in the small establishments and larger establishments, it is already there. It would be a significant competitive advantage for the banks. And so that is, I think the banks are gaining competitive advantage at the cost of NBFCs, and I am sure there is space for both, but that is one longer term thought that we see.
So, the entire pitch what NBFCs and MFIs had, that they are focusing on capturing the unbanked consumer, they were trying to make life easy for a borrower because their lending was also widespread. You think that entire scenario will get challenged because of digitization? Banks will be able to regain their connectivity and they will be able to lend better. So, you are saying that NBFCs, at least the MFIs, run the risk of underperforming now?
See, I mean, let's not link it to stock prices, because they have underperformed and it depends on where you are in terms of stock prices. But as a business model, I think the moment customers are using digital, individuals, and the moment businesses begin to use digital modes of accepting and transferring cash, banks have a definite competitive advantage. And the moment you are on POS and along with GST, I mean, more digital transactions along with GST should lead to a sharp reduction in the informal economy. So, the moment you are in the banking system, it is easier for banks to access you and to service you.
You liked wholesale banks in the past. You continue to like wholesale banks. One of your key holdings is State Bank of India, followed by ICICI Bank. Now, the challenge for wholesale banks is that the liability franchise has got bloated up because of deposits, and lending has only dropped. State Bank of India, I think 2 days ago, they've brought down their credit growth outlook from 11% to 9%. The idea of buying wholesale banks earlier, you told us that you were betting on demand revival and credit offtake to pick up. If State Bank of India is cutting their credit offtake targets, some would argue that the investment cycle is not picked up and may not pick up for another 2, 3, 4 quarters.
See, in fact, State Bank is just the opposite of a wholesale bank. So, it's a corporate bank. I think you have. So, we have bought very liability rich banks. So, they are the most retail banks. The deposit based is the.
That's one way of looking at it.
And but yes, what we have bought is corporate banks, because that is where the high provisioning costs are, and that is what is leading to suboptimal profitability. So, yes, you are right that the credit growth in the current year is slightly lower than what was envisaged earlier, but I think what State Bank is doing is pretty interesting, because it shows that how low their cost of deposits is, and that is the real competitive advantage of a financial institution, the cost of funds. So, I think the liability rich banks are quite well placed in my opinion at this point of time. They have gained deposit share, and now probably they can gain share on the asset side.
But demand is missing, Prashant. The argument is that, okay, I may have a great liability franchise, but I'm not in the business of collecting deposits. I also have to lend intelligently. And for me to lend intelligently, there has to be an offtake, which is not there.
Yes, so you are right. For the current year, the credit growth is much less than what was earlier envisaged. But I don't think the situation will remain like this for
Why do you say
forever.
that?
Because retail is growing,
Okay.
retail continues to grow. On the capex side, we are seeing good action, good movement on the roads. Railways, you will see current year itself, there is very good progress, and that should continue to gain momentum over next 2 years. In power T&D, I think things continue to look quite good. The private capex is still weak, and I think one of the key reasons why private capex is not coming back the way it was envisaged is because in the last cycle the power generation was a very big driver, and that is unlikely to come because we don't need that many power plants. But I think I mean, longer term it is very reasonable to argue that the credit growth in India should be ahead of GDP growth. I think there are very strong reasons to believe that. I think 12-15% credit growth we can expect next year onwards.
You've liked oil marketing stocks in the past. That was a good call. BPCL has been one of your key positions, but now it's come down the ladder. Maybe you've booked some profits there. But do you think that one-time re-rating move in OMCs and oil marketing stocks, is that behind us? Because markets are no longer valuing them as distressed assets. Now market are valuing them pretty much based on free cash flow and as marketing companies.
I think that's a very good question, and let me take you back 3 years.
Yeah.
So who has made the most money in these oil companies? Someone who bought these companies 3 years back.
Yes, yes.
Not someone who has bought them when the earnings have come.
Yes.
3 years back these companies were burdened with subsidy, and someone who took the view that look, over next few years I believe these subsidies will reduce, they will go away, and these companies will revert back to normal levels of profitability. There you have made 3 to 5 times the money. And today I think some of the sectors what we discussed earlier are exactly in that position, and that I think once again brings us back to the same point that in stock markets we must think beyond 2-3 quarters, we must think few years at a time. But in these sectors, I mean, these are very good companies, these are very strong companies, very sustainable businesses. So I would say they are, in my opinion, they are somewhere close to fair values. I mean, I don't think there is deep undervaluation in that space anymore, and I think most would agree with that view.
Your top holding actually is an IT company, Infosys. I'm not getting into an Infosys specific discussion with you. I respect your compliance, but I want to understand the scenario of IT. The letter which came from Vishal Sikka yesterday to his employees, it is indicating that they need to reboot themselves. The legacy issues will haunt us. If they don't change, they'll be forced to shut down. NASSCOM has cut their guidance in the middle of the year. I'm not getting very positive vibe from IT companies when I speak to them. They're admitting that the landscape is changing. So are you confident that business and earnings will revive for large cap IT?
This we have discussed in the past on few occasions, and our view remains the same, that this is a great sector. India has some of the best quality companies in IT services, and it is driving growth, driving business from the Western world. IT spends are growing, but at a much slower pace, and in the past these companies have grown much faster by gaining share. And there is a limit to those fast growth rates when you are growing by gaining share. I think this sector remains very competitive, globally competitive, and I think it should grow over time, because IT, the way business is being done across the world is changing very fast. I mean, technology has become integral to every business. So what do you do when technology is becoming integral? You will need to outsource.
Then why is growth contracting? I understand you and me use more IT, we are using a more smartphone, we are checking more sites and we are going more
Think
digital.
of it from the perspective of a bank or a retailer or a pharma company or an auto company. Technology is becoming core. If you don't adopt technology, you will fail. I would presume in such an environment, the need for outside help will increase over time. But yes, you are right. I mean, automation, which in the way software is written itself,
Changing, yeah.
is reducing the. So that is what we are. These companies are navigating right now. But I think IT has been changing every 5-10 years. You can go back. I mean, in '99 we used to argue that there is no future beyond Y2K.
Y2K, yes, so right, so right.
But what has happened? So I think yes, companies which change, companies which are agile, they can do better in the days to come. But I would also again say that the base is large. We should not expect very high growth rates, in my opinion, over the next 3 to 5 years. Though opinion is pretty divided on that. Some companies are more optimistic, some are not so. So I don't think it is very clear to my mind what growth is going to materialize.
Whereas on a long-term basis, markets will always align to earnings. As a fund manager, you always have to buy a portfolio where you can buy earnings. But liquidity also matters. And for the moment, it appears that the bull market in bond is over. Money is moving back into developed market equities. Emerging markets may underperform. FIs, they continue to sell. Is that a risk or that is just a structural adjustment?
I think liquidity is, I mean, it's a very, difficult to address because one, it can change extremely fast. There is no, you can take a view on earnings, you can take a view on a business, but you can't forecast who will buy and who will sell next month itself. So I have seen that there is a good correlation between the value of a business and what you pay. And I think this market offers a lot of opportunities for someone who is slightly patient. And so there are many businesses which offer value. I mean, if you look at FII sales, I mean, coming to what you are saying, I think it is okay. I mean, in last 23, 24 years that FIIs have been investing in India, there have been only 2 or 3 years where they have sold as a year. But there have been many quarters where they have sold. So I think when US rates have risen so sharply, it is logical to expect some impact of that on FII flows. I think we are in that phase. But I still feel that India will weather extremely well this phase of rising US rates because one, our current account deficit is very low. Our FDI flows are very strong. Our forex reserves are quite reasonable. Economy is in good shape. So I think over time we should again see these foreigners coming back. And in a way it is good that the local flows are so strong when the FIIs are selling. So I think it is giving a good opportunity for locals to buy in a market which is reasonably stable. And one final point is, in the past, whenever foreigners have sold for 1 or 2 quarters, for whatever reasons, or maybe a year, these have proven 3 years later to be the best times to have bought into these markets.
I've looked at the lovely research. I stumbled on that research. A year from now, 2 years from now, the returns have been strong. So is this like history not repeating itself, but history rhyming? I mean, this market is giving you a good opportunity to buy some of those stocks which you always wanted to buy because now there's a Flipkart sale on 15-20% cheap.
Yeah, I think yes. Just imagine in 3 months, in 6 months, in 9 months, a day will come when FIIs stop selling.
But the selling can intensify also. Huh? Who knows? The selling can intensify also.
It is possible. It is possible. I mean, it can't be ruled out. But with every passing year, India should get better. And see, last 6-9 months, what have we seen? We have seen US yields move up by 1%.
Yes.
It is massive. Even in India, if 10-year yields move up by 1%, it will be quite surprising in a short period of time.
And 1% in US is actually more than 80% because 1.5 has become 2.4, 2.5.
So I think we are right now digesting the impact of that. But over time, US rates should stabilize. Even if they are higher 2, 3, 5 years from today, the pace of increase should be far more moderate. So I think FII selling over time should moderate. But in any case, if you look at from the local perspective, real estate is not doing well, gold is not doing well, interest rates are pretty low, local flows are very strong. I think thanks to many participants, people like you, industry, IFAs, banks, media, the awareness about equities in India has steadily gone up and we are moving in the right direction. So we don't see investors panicking when 1 year returns are not there or when markets correct a bit. So I think equities are being understood the right way and SIP has become a very healthy way of
I've been told 4,000 crore on a monthly basis is coming via the SIP route for the industry. 4 to 5,000 crore.
Yes, I mean maybe slightly less.
Slightly
but,
less. It's a fat number.
But industry in aggregate is collecting almost 8-10,000 crores a month. This number is big, but it is actually much below its potential.
Of course. It looked like a dream number 3 years ago, let me put it this way. So my next question to you is that the best of the gains in fixed income are over. Interest rates will not come down like the wave they've come down in last 18 months. Gold is not going anywhere. Real estate may not be a very viable option. So first let's start with fixed income and then I'll talk about asset allocation. What is your view on fixed income for next 2 years?
I think most managers and certainly HDFC Mutual Fund has been consistently saying for last 3 years that interest rates in India will move low. I think that has played out.
Okay.
So I think if you ask our view today, interest rates still maintain a downward bias, but the room for fall is clearly now much less than where it was 1 year or 2 years back. So I think there is a case for investors to set their expectations on returns from fixed income at a lower level, and I think by and large people understand that because even bank FD rates have moved quite low. So I think fixed income now should not probably be with your investments in fixed income should not be with the intention to earn double digit or high returns, but with the intention to keep your capital safe. That part of your capital which you don't want to take risk on. I think that is the role of fixed income.
Any other interesting investment option or proposition which is opening up? You participated in perpetual bonds. Small category, but that category may just grow because there the yields are slightly better.
Yeah, so I think these tier 1 bonds of banks, it is a developing market, and it's good that mutual funds, some insurance companies, corporates, they are beginning to participate in this market. We think since it is new, it is less understood by the markets, and markets have generally had a negative view on the banks. Therefore, the yields in this space were quite attractive. Even today they are quite attractive. So I think yes, that's a good asset, and I think it will become, markets will understand this better as we go along, and it is good for the banks also, good for the economy because it gives them additional source of capital.
For someone who's aspiring to, let's say, get a double digit return, I'm not talking about 20s and 30s, I'm talking about 10-11%. Fixed income is out of picture. Post tax, government FDs will give you 4 or 5% return depending on the category and the tax bracket you are in. So by force, you have to look at equities, right? I mean, that's the only asset class left where you have to increase your allocation.
Yeah, yes, to target double digit returns, I think equities are probably the only meaningful option today. But I would not say that fixed income is, you can't look at the returns in fixed income in isolation. If inflation is 4% and if you get 7-8% on fixed income, it is good.
Yeah.
It is not we should not say it is not important at all. When returns were 10-12% in fixed income, so was your inflation 7-8-9%. So I think real returns in India, real interest rates are still positive. So there is merit in accepting lower nominal rates but keeping safe capital in fixed income. But yes, if you want higher real returns, 5-7-8% real returns over inflation, then I think you have to come to equities, and that is what equities have done in the past, and I don't see any reason why equity should not do it in the future. Index today, if you look at slightly longer periods, most people focus on 1-2 years, but if you go back 8 years and today, in 8 years index has hardly given you any returns. So, pre-Lehman index was Sensex was more than 20,000. Today we are at 26,000. So, index is up 30% in 8 years, while nominal GDP is up 2.5 times. So, that is what I was saying earlier, that market cap to GDP in India is pretty attractive. So, I think equities certainly have that potential of delivering double digit.
So can I say that for a genuine long-term investor, somebody who thinks in years and believes in decades and is not looking at NAV on a daily basis, I know there are some folks who do that. This is a good time to buy because earnings recovery will start. Alternates are not doing all that bad. Index has been flat. I mean, this is like a dream come scenario. It's a dream come entry point for a genuine long-term investor. If you buy in Jan 2017, can next 3-4 years give you double-digit returns?
I think so, for sure. Why not? And I mean, let me also tell you that while index has not done well, your returns in mutual funds have been in double digits. I mean, they are not in 20 and 25%, but even in last 8 years, returns have been quite reasonable. So, I think, see, in equities, all you need is patience. It is the only, I mean, it is the easiest way to make money in equities, just be patient. You can do a simple exercise, look at the number of funds in India, mutual funds, whose NAVs are in 400 and 500. What does that mean? The starting NAV of all equity funds in India has been 10 rupees. So, you look at any fund which is 20 years old, 15 years old, you will find the NAVs are 300, 400, 500. What does that mean? It means that across funds, over time, money has become 20, 30, 40, 50.
That's the patience of long-term
investing.
investing.
That is the patience.
And that is what we should aspire to do. So I'll quickly, get in 1 or 2 comments from you, and then we'll wrap. We've extended appointment with you. You've not changed your view on IT and pharma, or have you? Because this price-wise correction has kicked in.
I think pharma we have not been very positive, and I think price correction has taken place. Multiples have contracted, but still they are, I think, not in the zone where I would say that they offer great value.
What about consumers?
Consumer staples.
Consumer staples.
Consumer staples, I think, are in the past. If you see consumer staples, whenever you have bought these companies at very high P's, for the next 5-10 years, they have not done well. If you bought Levers in 1995
yes,
at 40p, in 2005, you made zero money. I think consumers again are a very sustainable free cash flow generating business, but I think the growth estimates of markets, of analysts in my opinion, are higher than what I think is reasonable, and multiples certainly are still very rich.
Would you say that in case of discretionary as well? Discretionary may see a resurgence in demand because of drop in interest rates.
So I think we are seeing that already. So that is why when people say that the Indian consumer is weak, I think that is wrong. How can airlines grow at 25% CAGR for 3 years volumes if consumer is not doing well? How can cars outpace growth of two-wheelers and of soaps and shampoos if consumer is not doing well? I think consumer is doing pretty well. Consumer is in reasonable good shape. The discretionary spends have been growing faster, and I think they will continue to grow faster in the foreseeable future.
Beginning of the year we get into this big mega call, and you've taken big bets, you've taken sizable bets. That is what has differentiated you from from others and from competition. What would you say are your big picture trends for next 3 years in terms of sectors and themes?
So more than big bets, I think we have taken long-term bets and where we were confident, and I think so far by and large things have played out. Sometimes they have taken a bit longer than what was envisaged. I think when I look at next 2-3 years, I feel inflation will be less, currency will be stable, capex will revive. Private capex may not revive to the last cycle because one big piece of that capex is missing. I think there is merit in buying companies where earnings are much below long-term averages. So I think businesses linked to capex, be it corporate banks, be it even banks in general, be it engineering companies, be it even metal companies, I think they are, be it consumer discretionary.
So consumer discretionary, metals, engineering, wholesale, corporate banks, these are the themes which are better.
I think they offer greater value, and what we have seen is that market leadership tends to change in 6 to 8 years. So last cycle we see leadership was with FMCG, pharma. I think probably that will change in this cycle.
I was looking for that answer, but appreciate your time, and for your unit holders and for some of our viewers to get this kind of assurance that the long-term picture is intact, I think is heartening. It's a good start for the new year as well. Appreciate your time. Thank you for dropping by. Thank you very much.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.